Welcome back to the Daily Crypto Deep Dive. Right now, one of the most important forces shaping the crypto market isn't a headline, a tweet, or a sudden breaking news alert. It's something quieter, more mechanical, and far more influential than most people realize. Bitcoin is being held in place by market structure itself. And until that structure changes, the market will continue to behave in ways that feel frustrating, confusing, and often contradictory. We've seen the pattern repeat again and again. Bitcoin dips sharply, sometimes violently. It looks like the start of a breakdown. Social feeds fill with fear. Then, almost immediately, price rebounds. Not slowly, not cautiously, but decisively. The market snaps back into range. Rallies behave the same way. Momentum builds. Optimism returns. Price pushes higher. And then it stalls at what feels like an invisible ceiling. No follow-through. No continuation. Meanwhile, altcoins quietly bleed. Not because they're collapsing, but because capital never really reaches them in the first place. To understand why this keeps happening, you have to stop looking at Bitcoin as a simple supply and demand market and start looking at it as what it has become, a derivatives-dominated system. Spot buying and selling still matter, but right now they're not in control. What's controlling price is positioning, hedging, and the enormous weight of options markets. This is where the idea of an options wall comes in. When traders talk about an options wall, they're referring to price levels where a massive amount of options contracts are clustered. These contracts aren't written by retail traders making directional bets. They're written by institutions, market makers, and professional desks whose primary objective isn't to guess direction, but to control risk. Their goal is to remain neutral, profitable, and protected no matter which way price moves. When large amounts of options pile up around specific strike prices, those strikes become magnets. Not because anyone believes Bitcoin is worth exactly that price, but because the people who sold those options are actively hedging their exposure. As price moves closer to those levels, hedging activity increases. That hedging activity pushes price back toward equilibrium. This creates a strange effect where Bitcoin appears to bounce and reject levels almost unnaturally. Support holds when it feels like it shouldn't. Resistance appears without obvious sellers. Moves look violent but don't last. This isn't manipulation in the dramatic sense. It's structure. Right now, Bitcoin is sitting in exactly that kind of environment. Open interest in options is heavily concentrated around nearby price levels. That means every move away from the range creates pressure for market makers to adjust hedges. When price drops, they buy to stay neutral. When price rises, they sell. The result is compression, volatility without direction, movement without progress. This is why dips get bought quickly, not because everyone suddenly turns bullish, but because hedging flows demand it. And it's why rallies stall just as cleanly. The same forces that absorb downside also cap upside. This has enormous implications for how the rest of the market behaves. Another layer that's often missed in discussions around this options-driven market is the role of volatility suppression itself as a strategy, not just a byproduct. Large players aren't simply reacting to price, they are actively trading volatility. When markets compress like this, implied volatility falls, and that creates opportunity for desks that specialize in selling volatility rather than direction. By selling options and hedging dynamically, they profit from the market staying trapped, snapping back and forth without resolving. This creates a feedback loop where volatility is both the product and the target. Every sharp dip that fails and every rally that stalls reinforces the strategy, encouraging even more volatility selling. The longer this persists, the more fragile the structure becomes, because when volatility finally expands, it does so violently. That's why these environments often feel calm right up until they're not. It also explains why seemingly minor catalysts, a data print, a funding imbalance, an expiry, can suddenly trigger outsized moves. The market isn't asleep, it's compressed. And compression doesn't release gradually. It releases abruptly. Altcoins feel lifeless in this environment, not because nobody believes in them, but because capital is trapped. When Bitcoin is pinned by options positioning, liquidity doesn't rotate outward. Funds stay concentrated in Bitcoin and Bitcoin-related instruments. Traders aren't willing to take secondary risk while the primary market is unresolved. As a result, altcoins bleed slowly, not violently, but relentlessly. They don't crash. They fade. This is why people keep asking the same question. Where did all the money go? The answer is that the money didn't disappear. It didn't flee crypto. It consolidated. It moved into the safest, most liquid instruments available while uncertainty persists. That means Bitcoin, stablecoins, and derivatives. This is backed up by data showing that the vast majority of new tokens launched over the past year are trading below their launch prices. The market is no longer rewarding speculation by default. It's selective. It's defensive. Now, this structure also explains the violent dips followed by immediate recoveries we've been seeing. When price slips below short-term support, it often triggers stop losses and liquidations. These are mechanical events. Forced selling hits the market, price accelerates downward, fear spikes. But once that forced selling exhausts itself, there's often very little organic selling left. At that point, hedging flows and spot buyers step in. Price rebounds quickly. The move looks dramatic, but it isn't decisive. The key signal isn't the dip itself, it's the lack of follow-through. In true breakdowns, selling continues after the initial drop. In this market, it doesn't. That tells you the structure underneath is still intact. The same logic applies to rallies. Breakouts fail not because the market is weak, but because it's constrained. Until price can move far enough away from the options wall to break the hedging feedback loop, every move is likely to be faded. This brings us to the critical question: what actually changes this? The answer is deceptively simple: time and resolution. Options walls don't last forever. They weaken as contracts approach expiration. As time decay eats away at open interest, the gravitational pull of those strike prices fades. Once a large expiry passes, the market often feels suddenly different. Moves become cleaner. Trends establish themselves more easily. Volatility stops snapping back on itself. This is why upcoming options expiries matter so much. They're not just calendar events, they're structural resets. When a major expiry clears, the hedging pressure that's been pinning price can evaporate almost overnight. That's often when markets surprise people, because the behavior they've grown accustomed to simply stops working. There are three broad paths this market can take once that pressure eases. The first is continuation through the top of the range. If Bitcoin pushes above resistance after the options wall weakens and holds that level, it changes everything. Hedging flows flip. Market makers are forced to chase price rather than contain it. Spot buyers gain confidence. Liquidity rotates outward. This is when altcoins finally wake up, not slowly, but suddenly. The frustration of the range turns into disbelief as moves accelerate. The second path is a downside resolution. If Bitcoin breaks below support once hedging pressure lifts, the move can be sharp. Liquidations accelerate. Fear spikes. But paradoxically, this can also create opportunity. Once forced selling clears and price finds real demand, the market often resets from a healthier base. These moves feel painful in real time, but tend to be shorter than people expect. The third path is extension of the range. This is the least exciting, but also the most common outcome in the short term. If new options positions replace expiring ones, the wall simply rebuilds at a slightly different level. The market remains trapped. Volatility continues without direction. Patience is tested further. The important thing to understand is that none of these outcomes are judgments on Bitcoin's long-term value. They're reflections of structure, not belief. Long-term narratives don't disappear just because markets pause. They wait. This is also why emotions run so high during periods like this. Humans are wired to seek resolution. We want confirmation. We want to be right. Range-bound, derivatives-driven markets deny us that. They punish conviction. They reward flexibility. This is where many participants make mistakes. They overtrade noise. They confuse frustration with information. They assume boredom means danger, or that volatility without trend means failure. In reality, this phase is doing exactly what markets are supposed to do when uncertainty is high. It's compressing. Compression builds energy. It forces weak positioning out. It concentrates capital. And when it finally resolves, it does so decisively. What matters now isn't predicting the exact direction of the break. It's recognizing the conditions that will allow one to happen. Watching open interest, watching expiries, watching how price behaves when it finally moves away from the range. Until then, the snaps, the fake-outs, the sudden recoveries, they're not random. They're the signature of a market being held in place by forces most people never see. This doesn't mean nothing is happening. It means everything is happening underneath. The people who benefit most from these phases aren't the ones shouting the loudest. They're the ones who understand why the market feels the way it does and adjust their behavior accordingly. Less chasing, less reacting, more observing. Because when this wall finally breaks, the market won't ask for permission. It won't wait for consensus. It will move fast, and it will reward those who stayed calm while others got worn down. That's the real story right now. Not fear, not hype, structure. And going into next week, that structure is exactly what you should be watching. Stay sharp, stay patient. And as always, we will see you at the top.